Is Wells Fargo Bank in trouble again? So last week, Wells Fargo Bank announced, basically without warning or limited warning, that they were shutting down all personal lines of credit for their customers. And I think this is a major red flag. Now, a lot of people have very short-term memories. Either they don't know or they forgot. But about a year ago, there was something very important that came out about Wells Fargo. Over the last 4 or 5 years, Wells Fargo Bank, if you're not familiar, has had a lot of trouble. They got their own entire episode in the Dirty Money documentary series, one of only two banks. HSBC Bank was the other. So you can go on Netflix and look up the Dirty Money documentary series and then watch the HSBC Bank episode about drug cartel, terrorist organization, and organized crime, money laundering, and how the federal government didn't end up putting any senior banksters in prison, or the widespread and predatory fraud from Wells Fargo salespeople on their own customers. And the Wells Fargo fraud scandal ended up costing a lot of people their jobs. The CEO, the former CEO, got out with a golden parachute. The chairman of the board resigned, I think, in March of 2020. So there were a lot of problems for Wells Fargo. And then, like I said, in the last year, about a year ago, you had basically a whistleblower article come out in The Atlantic by a former investment banker who helped create collateralized loan obligations, or CLOs, decades ago. Now he's a lawyer and a professor at a university. His name is Frank Partnoy, and he wrote this extensive article in The Atlantic in July or August of 2020 called The Looming Bank Collapse. And it goes through a lot of different details, including him talking to sources about how Wells Fargo Bank may have around $1 trillion in off-balance sheet derivatives, including bad leverage loans, commercial real estate mortgage-backed securities, collateralized loan obligations, a bunch of other toxic sausage that they've stuffed off-balance sheet, very similar to what the Fed does with special purpose vehicles. In fact, who do you think helped Enron set up all those off-balance sheet special purpose vehicles? It was the large Wall Street banks. It was JP Morgan and others who helped Enron set up all these off-balance sheet special purpose vehicles to hide enormous amounts of losses or debt or liabilities or other toxic sausage. In fact, who do you think helped Bernie Madoff with his Ponzi scheme? It was JP Morgan. So the government is just copying financial innovation, and I'm using air quotes here, innovation in a bad sense, to what the private sector is already doing. And Partnoy alleges that Wells Fargo has an enormous amount of derivatives off balance sheet. So this may be why the bank, Wells Fargo Bank, is starting to reduce its amount of credit exposure. Now, in general, I would say it's a false narrative that all these large banks here in the US have way too much cash. That's going to blow up the banking system. There's not enough lending by the banks. But the truth is the banks always have their derivatives books, tens of trillions each, hanging over their heads. Wells Fargo was not supposed to have this exposure of derivatives compared to the other banks, but Wells Fargo bought Wachovia, which had a lot of mortgage-backed securities and commercial real estate exposure in the last financial crisis. So Wells Fargo is probably also heavily involved in derivatives as well. In fact, they had a booming derivatives book over the last 6 to 10 years in the shale oil boom that went bust over the last 24 months. When a lot of the shale companies, the smaller ones, went bankrupt, Wells Fargo had an enormous amount of exposure to leverage loans and junk bonds. Even worse than corporate bonds are leverage loans and collateralized loan obligations, because the collateral is either non-existent or even lower quality. So if you want to read more about that, I'll attach a link to the Frank Partnoy article from last year, which a lot of people have forgotten about. He issued a major warning, and then you had a rally in the bank stocks. You had the false narrative that there was this economic recovery, another false narrative that the banks have enormous amount of cash. The banks have so much cash now that this is the narrative, that the banks don't know what to do with it. But the truth is that even though these banks might have a decent amount of cash on hand, there's always the possibility of one bank blowing up because of problems in the derivatives market, and then that's going to create contagion. And that's why I made a video about Bear Stearns in the last couple weeks, because you're starting to see similar scenarios with the repo market and others to 2007. which is when some of the banks like Bear Stearns and Lehman Brothers first started having problems. Now, it took 12 months or 18 months before things got to really bad 2008 levels from 2007, but we are starting to see enormous amounts of cracks in the system. What is happening with Wells Fargo, in my opinion, is probably another example of why the bank's trying to conserve cash now, because if the economy is booming, if the economy is doing well, one would think that Wells Fargo wants to do more loans, wants to issue more loans, wants to grow credit, and that seems to not be the case. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, or you want far more in-depth research content, information, financial education, and analysis, there is far more in-depth articles behind the paywall, over 170 articles, charts, and audio podcasts exclusive for patrons. Only $5 a month. I charge less than anyone else in the space for premium content. I think it is an incredible bargain, including 16 new articles out in the last 6 or so weeks on a lot of interesting topics. These are in-depth articles that took me well over an hour or more to write, citing a lot of different sources, going through a lot of different topics, far more than I can provide in this free little video that YouTube's not even going to give me any ad revenue for. So if you would like to take a look behind the paywall, it's only $5 a month, and there is a lot of in-depth research on global macro, companies, and sectors. So if I could wrap up this short little video really quick, this is another major red flag with Wells Fargo. This does not fit the narrative that banks are flush with cash, that there's so much cash in the banking system the banks don't know what to do with. In fact, it's the opposite, because if Wells Fargo had that much cash, one would think that they would want to grow their loan book, that they would want to issue more credit, that they would want to give out more loans, and this seems to be the exact opposite of the narrative that's going around in the mainstream. I don't think Wells Fargo is going to be allowed to fail because the banks are too big to fail, and the odds are that the Federal Reserve Bank, if Wells Fargo is having problems, the Federal Reserve Bank is going to start buying hundreds of billions, if not trillions, in toxic sausage for 100 cents on the dollar and moving it off balance sheet into special purpose vehicles. And this is how stagflate tax lie and the system maintains the status quo. Meanwhile, you don't have anyone in the mainstream financial media talking about how the Fed is allowed to put toxic sausage into special purpose vehicles. This article that came out only about a year ago from Frank Partnoy warning about Wells Fargo. This is one of those rare Wall Street insiders, other than Nomi Prinz, who was a managing director of Goldman Sachs and Bear Stearns. She provides amazing insights about how the banking system actually works and how the banks are basically hedge funds now. They do not need to grow their loan book to make billions of dollars per year in profits. So the people that are looking at velocity of money are not understanding how the banking system has changed over the last couple decades. The banks take in depositor money or take in reserves from the Fed, all this free currency and credit, and then it is leveraged up so the banks can make hedge fund leverage trades on stocks, currencies, bonds, and over-the-counter derivatives. And that is the majority of profits for the banks nowadays. And that has changed a lot in the last couple decades.